Today we are going to cover an important topic, life insurance. Many don't even have any type of life insurance, not realizing the risk that they are putting their family in. Among people who do have life insurance, some assume that the life insurance provided by their employer is good enough. But is it? Even people who realize the importance of good coverage choose the wrong type of life insurance for their needs. So, how can we buy a good life insurance? We will take a closer look at that in this episode. Hello everyone, I am Vijay Mohan and you are watching Investment Insights. Who should buy a life insurance? If you have family members who are financially dependent on you, then you should definitely have a life insurance. If something happens to you, your family can miss you emotionally. You cannot do anything about that. But financially, they should not miss you at all. You have the option to protect them from that disaster. Buying a life insurance. Even though it is an option, do not leave it as optional. I see at least one GoFundMe request every week to help out a surviving family. I would hate to put my family in that situation. I am sure you are as well. So treat life insurance as a must rather than as an option. How much coverage do you need? Your employer might already provide a coverage of up to 2 to 3 times your annual salary. Is that good enough? No way. How long would that money last for your family? 3 years maybe? Maybe a little longer. After that? That is why you need a coverage of at least 25 times your annual expenses. Let's say that you have an annual expense of $50,000 on average. Then you would need a coverage of 25 times 50,000, $1.25 million. This calculation is the same for India as well. If your annual expense is 5 lakh rupees, then your coverage amount should be at least 1.25 crores. This is the absolute minimum need. More the better. Why is it a multiple of annual expenses rather than annual income? Because the amount of money we spend to run our family would be our need, not the money we earn. But why 25 times? It comes from the 4% withdrawal rule. The idea is the surviving family can invest the insurance payment in something that gives at least 4% growth. And that 4% growth is withdrawn every year for family expenses. So if the family gets $1.25 million, they can invest the $1.25 million in something that gives at least 4% growth. And they can withdraw $50,000 every year for their annual expenses. What that means is the $1.25 million will last forever. And so the family would never miss you financially. What if you have already saved some money? Then that reduces your coverage need. Say if your savings and investments are $250,000, then you can take this $250,000 off from your coverage need of $1.25 million. So your coverage need would become $1 million. How many years do you need the coverage for? Many buy the coverage for their whole life. But is that necessary? Not really. Life insurance is meant to protect your family during your potential earning years, not after your retirement. What is your plan to provide for your family after your retirement? If you are a financially savvy person, you would have paid off all your debts, including your house loan by then. Kids will also be independent. And so the annual expenses after retirement will be very low. You will be using your retirement savings to support you and your spouse. That means if something happens to you after your retirement, your family is not going to miss you financially, assuming you have good retirement savings. If that is not the case, you have a retirement savings problem, which we will address in a different episode. What I am saying here is, you do not really need life insurance coverage after your retirement years. So buy the coverage only till your retirement age. Say that you are 35 now. If you are planning to retire by 60, then you need life insurance coverage for only 60 minus 35, 25 years. Nothing more than that. Now you know how much coverage you need and for how long. Naturally, the next question would be, what kind of insurance should you buy? All you need is a simple, plain term insurance. Nothing fancier than that. Term insurance provides only one function, life insurance. That is exactly what you need. You don't need whole life coverage, minimum return guarantee, cash equivalent, or any other bells and whistles. They are all there in the market for one and only reason, to make money out of innocence. Don't fall for that. Keep it simple. Just buy a simple and straightforward term insurance. It is so cheap that no other insurance plans can even come close to it. A healthy 35-year-old can buy a term insurance with 25 years and $1 million coverage for just $50 a month. Let me repeat, $1 million coverage for $50 a month. How much does a whole life insurance cost for the same coverage of $1 million? More than $1,000 per month, 20 times more than the term insurance premium. But Vijay, though we pay more, it has a cash value. In 20 years, the cash value will be more than the total value we would have paid. Isn't that a better deal? It would seem so, until we take a closer look at the numbers. Let's say that Appu is 40 now. He is buying a whole life insurance for $500,000 coverage. That would cost him $6,997 per year. I have made some rough calculations for the cash value based on the numbers I got from Investopedia. It will be $20,000 by the end of year 5. Cash value here means if you surrender the insurance at that point, this $20,000 is the amount you will get back from them. If something happens to Appu in the 5th year, they will pay the coverage amount of $500,000 plus part of the cash value. So a total of $502,000. By the end of the 10th year, the cash value of the account grows to $67,000 and the death benefit grows to $510,000. By the end of the 20th year, the cash value grows to $203,000 and the death benefit grows to $589,000. So in 20 years, we would have paid a total of $140,000, but the cash value of the account is $203,000. If we decide to close the plan at that point, we will get the cash value $203,000 in hand. Sweet. This is exactly how the agents will frame it to us. And it is very convincing, right? This is called framing bias. The data is framed and presented in a way so that we are easily convinced. Now let's see how this compares to a term insurance. Appu is buying a term insurance for $500,000 coverage and for 20 years till his retirement at the age of 60. The average annual premium today for that coverage is $335. Note, this is annual premium, not monthly premium. Right off the bat, you can see the price difference. $6,997 versus $335. You say that there is no cash value in term insurance, but the money you save is the actual cash value here. So by buying a term insurance instead of a whole life insurance, Appu is saving $6,662 per year. Is he going to leave those savings in his savings account? No way. He is going to invest that money in an equity index fund like the Vanguard Total Stock Market Index, which can give a long-term growth of 10% per year. But let's assume that he gets 8% growth every year. By the end of the 5th year, he will have a balance of $42,000. That is 100% more than the $20,000 in the whole life insurance scenario. His death benefit will be $542,000 at that point. $500,000 from the insurance, $42,000 from the investments. By the end of the 10th year, the cash balance will be $104,000. And by the end of the 20th year, it will be at $329,000. Do you see what's going on here? In a whole life insurance scenario, they are collecting big premiums, but only a small part of that premium actually goes for our insurance cost. A big chunk is going for investments managed by them. If we change the return rate of investments managed by us to 4%, then we can see the cash balance of term insurance coming close to what we see in whole life insurance. That means the whole life insurance is paying close to a 4% return for the example numbers we have used here. This is just an example. You can plug in your own numbers and compare the cash values between any other insurance and term insurance. So you can ask a couple of questions to yourself before making the decision. Would you be able to beat the return rate offered by the whole life insurance? In Appu's example, that is 4%. I say yes. But if you don't think that you can, then maybe whole life insurance is for you. But then you need to ask the second question, would you be able to pay the high premium they are asking for? Remember, our primary goal here is buying a life insurance for our needs, not investment. You should not settle for less coverage just because the premium is high. I know many who buy whole life insurance for just $100,000 coverage when their actual need is more than $1 million. Don't be that guy. Buy the cheaper term insurance instead. That will serve your need. It is always better to keep insurance needs separate from investments. Never mix them both. When we mix them, we think that we get the best of both worlds, but what we end up with is the worst of both worlds. So keep your insurance needs and investment needs separate. For insurance needs, just buy a simple term insurance. For investment needs, just invest in an index fund. It is as simple as that. In India, there are fancier insurance products like ULIPs. Stay away from them. If you run the numbers for those, just like in Apu's example, you will see that it is much worse. If your friend or a relative tries to sell a ULIP to you, just run away in the other direction. But do buy a term insurance. A healthy 35-year-old can easily buy a term insurance for 1 crore coverage with less than 10,000 rupees per year. A quick note about the term insurance. As it is very cheap, buy them for as long as possible. The premium price will not change during the coverage period. That means inflation does not affect the premium that you pay for say 30 years. Also, as you get older, the premium for term insurance goes up. So it is better to buy now when you are young and lock in the price. Or in other words, buy them as soon as possible rather than waiting till you reach a certain age. That is all folks. See you all soon in another episode. Thank you.